The Miracle of Compounding and the Dynamics of Leverage, a 12-year case study. In this video, we examine the cold, hard data from the last 12 years of performance in the U.S. stock market. We compare three major market ETFs, SPY for the S&P 500, QQQ for the Nasdaq 100, and IWM for the Russell 2000. Our goal is to uncover the power of consistent returns, the pros and cons of leverage, and how a small monthly enhancement strategy can potentially create significant wealth over time. We begin with the baseline comparison of SPY versus QQQ versus IWM. We look at the actual annual returns of these major ETFs. This establishes our baseline for what the market actually delivered. What are the key findings in this study? We see the clear winner QQQ here. Over the last 12 years, the ETF for Nasdaq 100 has been the undisputed leader in growth. With an accumulated return of 687%, it nearly doubled the performance of the S&P 500 at 363% and outperformed small caps by more than 4 times. The laggard, the small caps ETF, IWM, struggled significantly. Despite some strong years, the accumulated return was only 154%. This highlights that diversification into consistently lagging segments can still hurt total returns when long-term momentum is clearly concentrated elsewhere, in this case, the technology sector. Consistency matters. QQQ did not just outperform once, it delivered multiple breakout years, 30% plus, 40% plus, and even 54% in 2023, which created a performance cushion that helped absorb major downturns like 2022. Key takeaways. If you want growth, you must invest where growth actually exists. Over the past decade, that has been the Nasdaq 100. We update this video series periodically, so make sure to subscribe to this channel for regular updates. Channel subscribers can email us at qeinvesting@gmail.com to request unlisted private videos or playlists at no cost. Next, the double-edged sword of leverage, 3x ETFs. Now things get interesting. We examine the 3x leveraged versions of these ETFs, UPRO, TQQQ, and TNA. UPRO targets 3 times the daily return of the S&P 500. TQQQ targets 3 times the daily return of QQQ, and TNA targets 3 times the daily return of the Russell 2000. The performance of these leveraged ETFs illustrates a critical concept. Leveraged returns depend heavily on the strength and consistency of the underlying index, both before and after market downturns. Here we see TQQQ ETF, a real moonshot. Because the Nasdaq 100 experienced a strong and relatively persistent long-term uptrend, 3x leverage ETF worked exceptionally well. TQQQ turned the underlying 687% gain into a staggering 4,411% accumulated return. This represents an ideal environment for leverage. Significant gains were built up before major downturns. After those downturns, recoveries were fast and powerful. As a result, compounding was able to continue from an increasingly higher base. We also see TNA, the 3x leverage IWM. It is like the graveyard for investment. The performance of TNA provides one of the most important lessons in this video. Since the underlying small cap ETF, IWM, rose by about 154% over the same period, one might expect the 3x version to deliver roughly 3 times that return. It did not. TNA gained only about 72% over 12 years. Why? Not simply because of market swings, but because the underlying gains were modest. Before several major downturns, small caps had not accumulated large gains. After those downturns, recoveries were often slow and limited. Without strong upside both before and after drawdowns, TNA spent years repairing losses instead of compounding forward. The brutal math for recovery. If an investor loses 50%, this investor needs a 200% gain just to break even. Because TNA repeatedly suffered deep drawdowns, much of its capital was consumed by recovery rather than growth. Critical insight. Leverage magnifies returns in sustained trends, but severe downturns can seriously impair long-term compounding. TNA proves that you can be right about market direction. Here the IWM ETF did rise, but wrong about the investment vehicle, where TNA stagnated. Now let's discover the power of small enhancements. Here we ran a simulation using QQQ's historical performance and asked a simple question. What if we could add just a bit extra return in each month? We modeled monthly enhancements of 0.5%, 1%, and 2%, or roughly equivalent to 6%, 12%, and 24% per year. These levels of enhancement can be easily achieved by using various strategies discussed in the Quantum Edge Investing video series. The results are astonishing. For baseline historical return, that is, you buy QQQ and hold it for 12 years, you get a strong 687% accumulated return. Scenario 1, with a 0.5% per month enhancement, or roughly 6% annually. Here, the total return jumps to 1,415%, about double the baseline. What do we learn? By generating just an extra 0.5% per month, a very achievable target, you effectively double the outcome of a traditional buy-and-hold strategy over 12 years. Scenario 2, with a plus 1% per month enhancement, or roughly 12% annually. Total return increases to 2,516%. Here, you do not need double your risk. You simply just need to add a small and consistent gain each month. This small enhancement will triple the accumulated return. Scenario 3, with a plus 2% per month enhancement, or roughly 24% annually. Here, the total return explodes to 7,339%. This is where compounding becomes exponential, producing more than 9 times the return of standard QQQ buy and hold. So, what do we learn? You do not need to find the next Bitcoin or gamble on zero DTE options to build wealth. All you need is a high-quality underlying asset, like QQQ, and reliable strategies that consistently generate small monthly premiums. Over time, those modest gains compound into life-changing wealth. Conclusion: a sound strategy for the future. Based on the analysis of the past 12-year U.S. stock market, here is a practical blueprint for long-term investing. Choose the right engine. Focus on high-quality, strongly trending indices like QQQ. Avoid indices with choppy price action and weak long-term returns, such as IWM for core holdings. Respect leverage. Leverage can greatly enhance returns or severely magnify losses. Because market timing is rather difficult, protection must be planned in advance. Risk reduction is effective only when defensive positions are pre-positioned before market downturns. We present such strategies in Quantum Edge Investing. Target base hits over home runs. The simulation shows that the real power does not come from perfect market timing, but from consistent yield enhancement. Such enhancements are very reachable goals. In this study, we see that adding a small but safe return per month on top of a core holding can dramatically enhance long-term results. While Quantum Edge investing strategies often target higher returns, every strategy is designed to incorporate risk reduction. With defense strategy properly implemented, we can seek much higher return than 2% per month. We use a two-pronged approach, a profit strategy paired with a defense strategy. Investors are expected to master the defensive component before fully deploying the profit side. Our objective is to balance growth and safety, ensuring that returns are achieved without exposing the portfolio to unacceptable risk. Enjoy this marvelous finding. As the analysis shown in this video, even a small enhancement of 0.5% per month can double long-term outcomes, while a 2% or higher enhancement can create generational wealth. At Quantum Edge Investing, our mission is to pursue higher returns without sacrificing safety. We hope you find this video informative and useful. Please give us a thumbs up and subscribe to this channel for anytime access to this and other videos. As a subscriber, you can request private videos or playlists by emailing us at qeinvesting@gmail.com. That's all for today. Thanks for watching. Catch you in the next one.